Rollo Wright is a partner at Gravis Capital Partners, an investment manager with approximately £500 million of asset under management. Thank you very much for joining us today. Now you, it's worth pointing out, don't invest in those big transport projects, the roads, the airports. You're more social infrastructure, and there is a delineation between the two, isn't there?
Yes, I think it's fair to say that you could probably split infrastructure into two separate buckets. One in the more private infrastructure, like you said, such as the airports, and more public sector-backed social infrastructure, such as hospitals, schools, and that's where we particularly focus.
And what's the incentive? What's the pull for us wanting to invest in infrastructure debt like you do over equity?
Well, debt is lower risk. It's more dependable. It's more predictable. There's less variation in the cash flows. Infrastructure investments typically offer very long-dated, public sector-backed cash flows that are typically linked to inflation. So in this very low interest rate environment that we're currently finding ourselves in, investors are very keen to find yield, and infrastructure assets offer exactly that. They offer long-dated, yieldy assets the assets that you mentioned, hospitals and schools, that are backed by the public sector, offer a degree of security for investors.
How secure, though, are they when you take in mind that the economy itself might be going into recession because of austerity and so on and so forth?
Yeah, I mean, obviously infrastructure assets will vary in their security depending on which government is backing them. If you look at the UK, where we typically make most of our investments, you've got to look at the UK government as a credit. There are several reasons why we get pretty comfortable with the UK government. First is its fiscal independence, given that worst case it can inflate its way out of any of its problems. Infrastructure assets are typically inflation linked, so they have a natural protection against that. The last time that the UK defaulted, Queen Elizabeth I was on the throne in 1594, so there's a very robust 400-year track record. But most importantly, I think, from the UK's perspective, is that George Osborne's just announced a huge spending plan in the infrastructure sector, 50 billion in the next couple of years, 100 billion in the next decade, 80% of which it's planning to raise from the private sector. And given, as you just said, that governments are viewing infrastructure spend as a way of boosting economies, we view it's very unlikely that the UK government would jeopardise its ability to raise more money by defaulting or tinkering with existing contracts.
And you're almost providing, you as a company, alternative financing, aren't you? Because banks, they're pretty hamstrung by now.
Exactly. That's absolutely right. I think over the last few years we've seen the historic providers of debt to the infrastructure market disappear. The first would be the bond markets, which have been basically closed since about 2008, and the other, exactly as you said, is the banking market. But it's becoming increasingly difficult for banks to lend for long term, for 30 years, which is typically the term of some of these infrastructure assets. Basel II make it very difficult from a regulatory capital perspective, and also there's the balancing of assets and liabilities. The sort of Northern Rock model of borrowing short in the interbanking market and making 30-year loans is long gone. I don't think shareholders or boards of directors want to do that anymore. So there's a real vacuum in terms of where the actual debt to fund these assets is going to come from. Osborne touched on it recently. He's desperately trying to get the UK pension funds involved, and that is a possibility.
Rollo, thank you very much for joining us today. Rollo Wright there, a partner at Gravis Capital Markets.